Welcome back to the Williams Real Estate channel. Today we are discussing the macro market update for January 2026. There's a whole heap of data starting to evolve, which is confirming we are on track. We're on the blue marker, coming into the later stage of the 18-year land cycle, the final innings on that blue marker. Now, equivalent point of time in the prior cycle is early 2007. Give it 12 months to 18 months, we'll hit peak market. 2 years away, come 2028, we'll be into the next land-driven downturn. They'll call it something. Something will prick the bubble. This time round, I believe it'll be the high cost of energy, which will ultimately be the weak point in the economy for Australia, as it will get to a point where businesses won't be able to pass on the costs. They'll be shutting the doors and the unemployment rate will go through the roof. This is by no means not to deter anyone. This is the reality of the situation. This is our macro market view of the world. And we use it to work out, okay, where do we firstly sit in the market, being on that blue marker? And then from that, we peel back the layers to work out which market to buy into, when to stop buying, when to renovate, when to develop, and when to even sell out of. We have been sowing our seeds in Sydney, Melbourne, regional Victoria, and New South Wales as of late, as we're always 3 to 5 years ahead of the mainstream curve. You buy the future growth and not what has been historically. So we use this as a macro level, and people ask us, why are we still buying if we know there's a coming downturn? In 2007 and 2008, Sydney and Melbourne took off. So we're not waiting, we're getting in because it's already started in Melbourne. I see Melbourne troughed out middle of 2024 and has been only steadily rising ever since. We started buying two betters in the 200s. Now it's all 350 plus. One betters, we are still managing to get them under 300 grand, but it is becoming more and more competitive. So there's always a market to buy into. It's always a moving target, whether it's individual units, villas, townhouses in metro markets, or regional houses, or blocks of apartments. Everything works well in a well-diversified portfolio, but it's always a moving target. And we use the 18-year land cycle is the philosophy of my investing, not just property, but multiple different asset classes I invest in. But obviously, this is our property channel, helping to provide clarity to all you folks to work out whether or not you want to buy now or still on the sideline. But there's always a market to buy into. There's always growth. There's always a deal to be had. And I use this framework to work out, okay, where we are and where are we heading into the future, as then you can look at long-term trends and work out where to best deploy your capital for the future years ahead. Now, moving forward, the purpose of today's video is to give you clarity of how I see us still being on track on the blue marker and how I see it all evolving as the next couple of years play out. We have unemployment, which is tightened over December to 4.2%, so it decreased. However, you can still see how the trend has continued to trend up. As of middle of 2022, it troughed out around 3.5%. It has been slowly trending up. It'll continue to keep trending up. History shows once the unemployment rate starts to trend up, it only ever accelerates until something in the economy breaks, and then it will run high when businesses are laying off people, shoring up their balance sheets. It'll run high into 27 and 8 and onwards later decade. But this is definitely something we are keeping tabs on. It is low in terms of historical averages. Below 5% is low, but what we're looking at is the trend. It is trending up. So if this continues to trend up, we are on track. Second to that is the Australian inflation rate. Again, is starting to trend up. As of June, been trending up again, and as of December, it's up to 3.8%, up from 3.4% in the past 12 months, mainly being driven by the cost of electricity, which rose 21.5% over the past 12 months, and is also forecasted to increase by another 25% over the course of 2026. Hence, the RBA met today and they raised the cash rate by 25 basis points to 3.85%. Here we are again. We've been here before in similar points of history, pre-GFC. As you can see, from 2005, 6, 7, rates continue to go up, as well as late 80s, rates went up until it peaked out around 17% prior to the 1991 recession we had to have. So we are here again, and most likely history shows and the 18-year land cycle suggests that inflation and rates always end up higher to end the cycle. And the RBA's key remarks today was, while inflation has come down from its peak in 2022, it is now picked up again and is broad-based, and it is materially picked up from what they expected, and it's likely to stay above their 2 to 3% target range for the foreseeable future. The capacity in the economy is stronger than what they expected, and it was a unanimous decision by the board to raise the cash rate. So the commentary from the statement saying that they don't expect inflation to come down and the economy is stronger than expected, they're basically preparing everyone for future rate rises, I see, but I believe the RBA is behind the 8 ball. So time will tell, but I've already fixed the whole portfolio, managed to get 5.5% locked in. Happy days, and the fixed rates are already starting to go up. So I see rates going up over 26, 27, which will ultimately be the setup for the coming downturn. Meanwhile, a lot of first-home buyers are taking on big loans, 95% LVRs. They're taking up the first-home buyers grant. So this is the setup. We can see the Australian home loans continue to expand, even with higher rates, high inflation. They're taking on more debt. So as you can see, this is the final setup. Big credit expansion, high inflation, rates will end up going up. And most people that take on the big loans, buy the big shiny homes or the big fat mortgages, probably won't end up being able to hold on to them long term. So don't get caught up in the fuss. Don't need to take on big loans. Break it down into smaller pieces. Focus on buying property, high yield, under the intrinsic value, and then you'll be protected in the coming years. Copper price shooting up to all-time high, as now we are in an expansionary phase in the global economy. Construction and property is kicking into gear. This is drawing on copper price, Dr. Copper. So we have a good couple of years left in the tank. This is going to bring everyone in. Everyone's going to think we're on to the next wave. Everyone will be leveraging right up, and then ultimately inflation and rates will get away, and that will be the inevitable breaking point of the economy coming into 28, 29 and onwards. We keep a good look on what's happening in the US as the US leads. So they're tipped to top out over the course of 2026, and historically Australia trails 12 months behind the US. The US employment rate is what we keep tabs on, as just like what happens in Australia, once it starts to trend up, it continues to trend up historically, and then eventually it will spike and run hard, similar to what happened in the mid-cycle slowdown, also known as COVID. So it is starting to trend up. It recently pulled back in December, but it is trending up and will probably keep trending up over the course of 26 and 27 and into 2028. Inflation is sitting at 2.7% in the US, which is above their target of 2%. The Fed is sitting on their hands. They have dropped rates a couple of times over the course of 25, but as of late, they have held the cash rate at 3.75%, and Jerome Powell is indicating that he doesn't intend on dropping them any further. His term is up in May, and Trump is lining up a replacement, ultimately someone that will listen to Trump. He wants low rates. He's talking 2 to 3% cash rate. So you can imagine what that is going to do to the markets globally over 26 and 27. It's going to bring everyone in, low rates, pump up asset prices. It'll kick off inflation again. And this will be the inevitable setup we see at the tail end of the 18-year land cycle prior to the land-driven downturn. Stock markets continue to rally, hitting all-time high after all-time high. They are now broadly fully priced. There's not much earnings growth really expected. PE ratios are high, 20 plus across most stocks. So this is typical of what we see towards the tail end. It's what brings everyone in. They see high returns over the last couple of years in the stock market, brings everyone in, which is never a good idea to keep charging into overvalued markets, be it any type of market. We've got the likes of Warren Buffett, one of the most famous investors, sitting on over 360 billion in cash. He sees the writing on the wall. So he's cashing up. He's been cashing up since 2024. Personally, I've moved all my investments out of equity. So sold all my stocks. I've moved all my super out of the Australian ASX stock market and have reallocated it into a block of apartments, as I see that type of asset class outperforming over the next 5 to 6 years as we enter the next land-driven downturn, where there'll be a rush to affordable housing, where everyone just needs a roof above their head and will be bunkering down. That is the most resilient type of asset class you could be looking into over the next couple of years, is 1 and 2 bedroom apartments, either individual or the whole block, but definitely not stock markets. Historically, look at long-term trends and look what happened from 2008 and onwards is a guide of what stock markets will probably go through over the next couple of years. Crypto! The Bitcoiners have gone back into hermit. I suspect cryptocurrency will probably turn to dust come 2028 and onwards. Whether or not it's starting now, it might end up troughing out and going for another bull run between now and 2028. But very interesting to see the capital being drained out of the likes of Bitcoin. Definitely not something that I'm investing in over the future years ahead because there's nothing behind it. What is it? The woozy wuzzy, the blockchain. There's no intrinsic replacement value of cryptocurrency. There's more buyers than sellers currently, but when the market turns and people need cash to show up their personal balance sheets, especially if they bought overvalued property during the boom years and they end up in negative equity and they're getting margin call from the banks, the first thing to go will be crypto. So when there's more sellers than buyers, it'll probably go to zero because there's nothing behind it. It's not like buying a house or a block of flats where you got bricks and mortar. It is the woozy wuzzy. DR Horton, we keep tabs on, as historically it lost 66% over just over 2 years from July 2005 to October 2007 before the entire stock markets topped out. So that's a leading indicator for us that we keep tabs on. And as of late today, DR Horton has lost 23% over 16 months from its peak in September 2024. So this is a leading indicator for us because this is a land and property developer. And as they continue to price in reduced earnings, as land price softens, their valuation will continue to go down, which will counteract their share price, which is a leading indicator before the overall markets top out. So keeping tabs on it, there's a good 12 to 18 months for it to continue to trend down. If it does continue to trend down, it'll indicate that we are coming pretty close to the market topping out globally. As always, this is by no means financial advice. I'm not a financial advisor. I'm a property investor and I help people do the same by way of buying investment grade property. So before taking any action, be sure to get financial advice, independent third-party advice from your accountant, legal advice, financial planning, etc. If you want help, building a long-term sustainable portfolio through the turbulent times ahead, shoot us an email today. Happy to jump on a call, discuss where you're at, discuss what your plan is over the next coming years. It's going to be turbulent times. So don't get caught up in the fuss. Don't buy property with yields of less than 5%. Do not buy property for over the intrinsic value. Buy property for at least half, if not a third, of its intrinsic value with strong yields between 6 to 8% in markets that are timed using the overall 18-year land cycle framework and overlaying it with long-term historical trends, and you'll never go wrong. Until next time, thanks for watching.